Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. It was all about headline risk in the U.S. News on those tariffs sparked a lot of volatility in equity trading. President Trump delaying levies on Mexican and Canadian goods covered by the North American trade deal. In a moment, we'll be speaking with Carin. She is the Executive Vice President and Head of Portfolio Management at Fiduciary Trust International. But we begin in Tokyo. Earlier this morning, Bank of America CEO Brian Moynihan sat down for an exclusive interview with Bloomberg's Shery on. Here's part of their conversation.
And Brian, good to have you in the Tokyo studio.
It's good to be here, Shery. I mean, it's a very exciting place these days.
I mean, you guys have been operating since, the end of World War II. How is your business going?
It's great. And so we operated in the banking side since the end of World War II. We've operated on the security side and became a full member in 86. So we've been here a long time. About 800 teammates, one of the largest non-Japanese banks in the city, corporate banking, investment banking, treasury services, and obviously the markets business. Done very well here.
What parts especially are we seeing more excitement about?
Well, if you think about Japan, the excitement overall is the changes in structure. Obviously, the interest rate structure coming up, inflation from a country had no inflation for years, for 30 years. It changes people's attitudes, wage growth. And then also on the other side of it, you're seeing the corporate reforms going through, which are critical, and the push for the government to move the money outside the deposit banking system into the investment system, which will happen, which is drawing a lot of interest from outside world. So we're hearing a lot of M&A dialogue, and it was up last year, and we expect it to be up this year. We heard about 30-40% of our revenues of Asia are in here in Japan, so strong. We're seeing a lot of market activity, and then the flows, the capital flows, the treasury services business, which isn't exciting as an M&A deal, but it's critically important to the profitability of our company.
We were just mentioning 7&I, for example, and I know that you guys have been involved with them. We are now hearing potential listing in the U.S. business?
I'd have to lead to my teammates. I don't get involved in a deal, but look, we have a great team here, and they do a great job, and if they think it's the right outcome for our customers, they'll tell them, and we'll see what happens.
But that's sort of part of that corporate reform story.
Yeah, it is. That's the idea. We've been with government officials and clients, and the companies are excited to have in the classic word, animal spirits. Let's get moving. Let's merge these companies together. Let's modernize them. Let's keep working on the cost structure. You have very low unemployment rate here, 2% plus, very low. There's plenty of capacity to absorb, employees. There's a little more competition for wages, competition for employees, wage growth. So I think all that sets up the ability to get the reforms going through, whether they're corporate reforms, return reforms, that demands that you've got to return capital, getting cash off the balance sheet of these corporates, either back to shareholders to do something. But in the end of the day, you got to come back, and it's got to be wise deals that are strategically important, that add value, because spending money is the easy part. Making it really get the returns after you spend it is the hard part.
There's more in the pipeline for Bank of America when it comes to deals this year.
Yeah, it just the amount of conversation, amount of excitement, both inbound from outside the rest of the world, and also outbound from the large companies here continue to expand, across Asia, but importantly into the United States, because, frankly, a lot of the manufacturing debate that you talked about in the earlier section is they need to expand their manufacturing to maybe avoid potential tariffs, which is unknown what's going on.
Yeah, how much does that add to business uncertainty for you?
Well, I think clearly on the business side, after the election, you had businesses very enthusiastic about the lower regulatory burden they'd have, the ability to get deals done. And you went from conversations last summer, which were sort of interesting conversations with the boards. Our teammates tell me they go in and they talk and they'd show them these deals and they'd say that makes sense, but it may be hard to get it done now, to, get in here and let's talk about these deals. President Trump's administration has made it clear they're trying to get some things done, which may cause some short-term, sort of lack of understanding. That affects the business community, but they're saying, in the end of the day, and the president said in a speech the other day, we may have some short-term disruption to get to the long-term goal of downsizing government, downsizing regulation, et cetera. And I think the businesses now are sort of saying, well, I've got to figure that answer out. And that's fine, because it's what it feels like forever, a month or two or three. But meanwhile, on the consumer side, you're not seeing any change in activity, despite what they're saying, which is interesting.
Tell us a little bit about that, because in your last earnings call in January, and that was before the inauguration of President Trump, you were saying that consumers were still spending more than last year. Is that still the case?
So if this is sort of the dichotomy of what a consumer says they're thinking about versus what they actually do. So if you read the information of the last month or so, consumer confidence has come down and they're worried about inflation going up and all that. That's sort of what they say they're going to do. What they really are doing, in the month of February, they spent 6% more money out of our accounts into the economy than they did last February. And year to date, it's about 6.5%. You compare that to the fourth quarter, it was about 4.5%. We felt pretty good about that. So the consumer is still spending. And by the way, if you look at what they spent on food, basically flat in February. So despite the discussion about egg prices and things, the actual total expenditure is about flat. Services, travel, entertainment, growing, and that helps drive jobs because all spending by consumers drives jobs, but the ones that are service-oriented and the entertainment require a lot of people to service them.
Aren't other policies from the administration, though, a little bit more disruptive when it comes to, say, immigration and hiring for these small and medium-sized businesses?
Well, if you go to small and medium-sized businesses, they've been facing two issues. One is the real cost of money went up a lot for them because they borrow on lines of credit, short-term lines of credit, and so they have to make sure when you're talking about you have SOFR at 4.5% or whatever plus their spread. That was SOFR at 50 basis points plus their spread. That was a big change in rates. So they had to always be more careful. When you saw them kind of conservatively handle their lines of credit usage and stuff, then the election happens and they feel really good about the regulatory. But they started noticing they weren't be able to hire as easily and stuff. And so they're worried about where people think they're worried about inflation, they're actually right now a little bit more worried about getting employees and running the businesses. And I think as these policies settle in, you'll see them settle in. But they were over-regulated. All companies were, but the small, medium-sized businesses felt all the labor regulation stuff. We have thousands of people who can deal with it. They don't. And so if you're running your own business, and they feel good about that, but it's offset by let's get a set of rules set and then we can go.
How soon do you think they'll get some help from the Federal Reserve by lower rates?
Well, the market now, I think, put 3 cuts in after some of the data. And the market's been all over the place in a sense because over the last 90 or 120 days, I bet you we've had 5, 6 cuts to 0 cuts back to 3 cuts. Our team believes that the Fed is kind of done cutting rates until inflation kind of gets in control. They believe that and I'd say they may, as they're thinking about that, given that if these tariffs go in, they thought that it would have some impact on the growth in the U.S., and that may cause them to think about that. But right now they're saying, look, you've got a real rate structure, which is Fed. You've got employment pretty stable and loosened a lot over the last year. And so maybe their view is there'll be no cuts. We'll see what happens if they start to see.
You also don't think inflation is getting under control or there are upside risks?
Our team of economists always thought it would take 3 years to get inflation under control. And so they projected to get down near the target towards the end of 26, but it takes that long. And everybody says, why isn't it happening faster? It just takes a while for it all to work through the system, especially with the amount of stimulus and other things that went on.
In the meantime, you talk about markets being all over the place. Yeah. Has that increased your activity in that sense, in business and markets activity?
Well, if you look at the first quarter, we told we gave our guidance in our first quarter call, and NII was going to be up flattish quarter to quarter with 2 less days. That looks in great shape. Loans and deposits are what we expected to happen. The trading revenues been strong and up from last year, mid-single digits type of numbers. So we feel very good. I'd say the M&A, the debt capital markets open and processing through. The equity capital markets, as we talked about, a little slower but still solid. Everything's in good shape. And then asset, then the wealth management business very strong. So we feel very good about the current prospects of our company.
Same here in Japan, because we saw the brokerage unit, for example, posting a loss for Bank of America in 2023. Did it get better last year?
Yeah, you got to be careful of our legal entities because we don't run the business that way. We run the global things. But the group here made about 30% of the pre-tax profit for Asia. They're a very strong group, and so sometimes the mechanics of how that runs through because of the bank and the broker dealer and the parent. I wouldn't get too concerned about or too interested in the legal entity profits. When
it comes to the JGB trading aspect of things, are you seeing more interest? Are you building that up?
Yeah, we continue to add people in the trading business across the world, honestly. Jimmy DeMar's done a great job. We've moved up about 200 basis points or so in market share across the last 5 years. We've given them more balance sheet, more risk to take. They've done a good job of deploying it, and they keep adding everywhere. As the activity picks up, we're adding people here, too.
Yeah, because, for the first time in a very long time, we are seeing a lot of volatility in the rates market, a lot of interest as well. We've heard about difficulties hiring, for example, rates traders, because all of a sudden this became so exciting.
That's going to be true. And I think that one of the keys, and you personally are thinking this, there's a lot more people coming from the outside to work in Japan, and the rules and regulations allow that to happen. So we'll also hire internal people, but if there's not enough, we'll bring people from around the world to help on it. It's an exciting city to live in Tokyo, so it's not hard to get people to come here. And you're able to get them in and work, and so we feel good about that. And from the country's perspective, that's one of the things after women came into the workforce and after there were people worked a little longer, what you're seeing is foreign workers coming in of all different types now. And so we feel good about that we can get prospects here. But it is a tight labor market, there's no question. A lot of talent, but a lot of demand for that talent.
We are seeing also a lot of interest by activist investors, and you have a big advisory in that sector. What are you seeing in terms of
We
business?
agree with you, and I think I'd be careful about only equating that to activist investor. The pronouncements by the government and the exchange and stuff that you've got to move, the amount of cash on these balance sheets are making things happen. So activists can catalyze that activity, but at the end of the day, what's going to also catalyze activity is boards of directors and management teams saying, we have been given a mandate to change, and now with the interest rate and inflation and things, a billion economy, we got Japan growing at 1%. That doesn't sound great, except for where it came from. That is great, and so I think that is going to cause more activity necessarily. So yes, there's activists, and we have an advisory business that helps people through that discussion, and they'll cause activity. But the imprimatur, or the imprimatur by the government to drive activity, also causes it. And when I talk to CEOs of companies with big market caps, they're figuring out how to reposition themselves to keep driving.
Are you using more of Bank of America's balance sheet in trading here in Japan compared to other parts of Asia? Asia, we have 5 or 6% growth, so you really have to be careful. So in Australia, we have a great business, and so we've added about $200 billion across the world in trading balance sheet. And what percentage of one here? I have to get somebody to give me the statistics, but we're supporting the business everywhere. Some of the things that we've seen across the world, of course, we've talked a little bit about the fragmentation, about tariffs. When you see that growing rivalry between China and the U.S., for example, is that something that concerns you as a CEO when you look at Bank of America's business?
Yeah, our business is going to reflect our customers and clients, and so in the U.S., that's consumers and wealthy consumers and business of all size and corporates and then investors. Outside the U.S., our business is very specific. It's large companies, and large investors, and so anything that causes them to move money, we have to follow and help them do it. So it'd be great if everybody were all on the same page and everything was perfect. That just never happens. It's never happened in the world's history. It's not going to happen tomorrow either. So I think the concerns of how to move money around and how to where to invest, I think at the end of the day, we're sitting here in Tokyo. This has become a favorite place to look, and there's other places like this around the world. The United States is a strong place to look as we travel around Europe and other places. So I think it's really going to reflect those customers as opposed to us catalyzing activity and us running our business differently. We run our business to support our customers and clients, and they dictate the activity, and then we help advise them about that activity. And what we're saying is they're enthusiastic about the growth in the U.S., the growth on a global basis, 3% plus, the rate structure coming down a little bit across the world, the ECB cut rates. So they're feeling good about it. They just need a business likes plans 3, 5, 7, 10-year cycles, and it's hard to do that when there's this much movement. But on the other hand, they face this all the time.
That was Bank of America CEO Brian Moynihan speaking exclusively with Bloomberg Shery on. Coming up, Carin from Fiduciary Trust International. This is Bloomberg. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. So we know now that the Trump administration is suspending tariffs on U.S. imports from Mexico and Canada covered by the North American Trade Agreement for a period of 1 month. But the headlines on tariffs today sparked a lot of intense, quick, and sharp swings in the equity market. At the end of the day, there were losses right across the board. We had the S&P down 1.8%, NASDAQ comp weaker today by 2.6%. For a closer look, I'm joined now by Carin, Executive Vice President, also the Head of Portfolio Management at Fiduciary Trust International, joining us from here in New York. Carin, thank you for making time to chat with us. What's it been like in the office these days?
It's actually been relatively calm. We have not heard a lot of panic calls from clients, but I think it's starting to pick up a little bit in terms of, clients are starting to ask questions and not surprisingly, right? Because there's a lot going on in the news and, there's a lot to keep up with. And there's certainly, a greater degree of volatility in the market that we're seeing, as you mentioned. And so, it's been relatively orderly, but I would say that it's starting to pick up a little bit in terms of just the attention being paid to what's going on in the market.
So have you been making adjustments to your portfolios with all of the headlines that we've been talking about, whether it's on the economic data side or whether it's on the tariff side? Are you adjusting positioning?
Well, I would say that we have been adjusting positioning kind of coming into the year. In December, when we were thinking about 2025 and the outlook, we sort of expected that perhaps in the upcoming quarters that we would get some market volatility. We recognize that valuations, towards the end of the year and kind of coming into this year were at the higher end of the range. We also recognize that the market was very concentrated in terms of what was driving the markets for the past 2 years. And so coming into this year, we sort of felt that there would be more volatility expected. We were expecting that tariffs would be a topic of conversation. We thought that there would certainly be uncertainty related to tariffs, and therefore we've been rebalancing portfolios just from a risk standpoint, from an asset allocation standpoint. We're still positive on equities because the fundamental backdrop in terms of the economy, in terms of the pro-growth, pro-U.S. agenda is still sort of the main theme for this year. But we do think that, right now we're going through a period of a soft patch or a pause that's being created by some of this uncertainty related to tariffs.
Do you think there's a risk that we could see a pickup in inflation?
Certainly, we would acknowledge that there is a risk. I think that that's been playing a lot into the bond yields. In January, we saw bond yields actually rise to about 4.8% because the markets were thinking that there could be tariff-induced inflation, but also that pro-growth meant that there would be an acceleration in the economy, and that combination could be inflationary. I think it's to be seen whether there would be and whether, to what magnitude. I think that it's definitely, on the table in terms of, how much is to be seen, because one of the offsets is that we are starting to see a slower economy right now. And, we have seen that some of these factors are caused by some consumers and businesses front-loading, their orders before the tariffs take place. So there's a lot of noise right now in terms of the data. And, there's also the part that businesses are not in a position to raise prices as much as they were able to do so in the last couple of years. So we're at a point where consumers are starting to push back, or they just can't afford these higher prices anymore. Certainly the lower income consumer is feeling a lot of those pressures.
So I hear that you're, broadly speaking, still constructive on the equity market. You've been doing some rebalancing, though, and I'm wondering whether or not you look to the fixed income markets as a part of that rebalancing. Have you been leaning a little bit more into fixed income?
We have. I think that over the past year, we have been leaning a little bit more towards fixed income. We are cognizant and we are paying attention to, just like we pay attention to valuations on the equity side, we do the same thing on the fixed income side. And, bonds were definitely a lot more attractive when 10-year bond yields were around 4.8% or north of 4.5. I think that right now with 10-year bond yields at 4.2, 4.3-ish, they're still attractive. We still think that they provide balance to a balanced portfolio. But we want to be more opportunistic and be more tactical in this environment. We do think that there are opportunities that are created based on the market volatility on both the fixed income side as well as the equity side.
Are you looking offshore at all these days? Are you seeing opportunities in Asia right now, for example?
Yeah, it's a great question. And of course, there's been a lot of recovery and significant moves in the Asian market, particularly in the Chinese technology stocks. We think that a lot of that has to do with the fact that they've underperformed so much in the past few years. And so, there really hasn't been any interest in that part of the market. And so it's easy to kind of see any positive news lifting those stocks up very quickly. And there's also, the news around DeepSeek and also now, Alibaba talking about the Chinese tech companies coming out with sort of better, more efficient technology around AI is helping to lift those stocks. I would say that we are definitely, recognizing that there could be a valuation catch-up in foreign markets. Particularly, I think we would say that it's probably more interesting for us to look at European equities than it is necessarily emerging markets or the Chinese market, just because longer term, we still see secular challenges and in terms of growth for emerging markets and for the Chinese market.
Carin, I'm curious about your cash position right now. Are you fully invested? Are you keeping a little bit of dry powder on the sidelines in case we get a little bit more of a pullback? I mean, right now, I think the NASDAQ 100 is flirting with a correction.
Yes, definitely. I noticed that as well. NASDAQ's down over 10% from the highs, as S&P down a little bit over 6%. So, we are getting into correction territory and, significant parts of the market. And certainly if you look within the equity market, there are, stocks that are down 20% or more, right? So, I think that there are opportunities in terms of market leadership and what's underperforming. We've seen a big recovery in value stocks, for example, this year, and some dividend yielding stocks, the defensive stocks. So it's really a matter of, to your question, what are we doing with cash? We have been, as I mentioned earlier, rebalancing portfolios, recognizing some of the risks. We've also sort of gone ahead of when we had, much higher valuations to make sure that clients that need cash, that we've raised the cash. Aside from that, I would say that from a portfolio positioning standpoint, we're more or less actually overweight a little bit fixed income compared to cash because we see better yield opportunities in fixed income. And the Fed right now is probably going to continue to lower rates. It's been a little bit of back and forth in terms of market expectations for the Fed. We went from expectations of one rate cut just a few weeks ago to now potentially 3 rate cuts. So the yields on very short-term cash could be going lower, whereas you can lock in some better and more attractive yields in fixed income.
It's interesting you make that point. We heard from Fed Governor Chris Waller today. He was saying that he would not support lowering rates in March. Even so, he does see room for 2, possibly 3 rate cuts sometime this year. Carin, great stuff. Thank you so much for joining us. Carin Pei there. She is Executive VP, also the head of Portfolio Management at Fiduciary Trust International, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.